In this video, I want to talk about a two-step process that I must see in order to take any single trading setup. Now, what I see a lot of people do is they try to predict the market. They wake up and they say, okay, Apple is gapping up 2%. As soon as we break $100, I'm going to play calls and I expect this thing to rip up. Or, okay, the S&P 500 is breaking below support. We're breaking below our wedge and let me get in the market short because I think it's going to go down. As traders and as humans, our brain and our mind wants to see what we think is going to happen, and it makes us believe what we want to believe. It plays these tricks on us. We can't predict the outcome. I cannot do it. You cannot do it. I don't know where the market's going to head. Neither do you. However, to position yourself on the right side of the market with a high odd and a high probability of the market moving in your favor, we must follow this two-step process that I'm going to go over in this video, and I'm going to relate it to actual trades that I have taken myself. Before we get into it, I'm going to post a link in the description below to follow me on my Instagram at Entrepreneurship. On my Instagram, I posted essentially what I was watching based off of what we're going to go in this video, and it's going to tie it in very nicely. And if any one of my followers seen this, they would have had a really nice opportunity to make profit today once you understand these points I'm going to go over. So the link for my Instagram is in the description below at Entrepreneurship. You're seriously missing out if you're not following this. So the first step of this process is understanding that there are levels to the market. The market moves, or how we can predict the outcome in a high certainty or a high probability, as long as the risk makes sense, is understanding levels. Playing levels and understanding these high levels of interest. We have to identify and create these. Now, how do we do this? We look at key levels, support, resistance, maybe something that we spot off of the tape, maybe a very large seller, a very large bid, a very large offer, a very large buyer. Anything that's going to give us a level of interest, saying, okay, there are buyers factored in here, or okay, there are sellers factored in here. This has a high odd of reversing the market. Or okay, this has a high odd of bouncing the market. These are our levels of interest. Once we get this first step, and I only use key levels or supply and demand zones, the next step is reacting to the market at these levels of interest. We must spot buyers and sellers at these levels of interest. So going back just to the first point and playing levels, what I see a lot of people do is they are not creating important levels of interest. They are just marking, let's just say, a pre-market low or a basic support and resistance level, which is okay, but they are looking at levels that really don't have an influence on where the market could head, where buyers and sellers are factored in at. So what they'll do is they'll just mark, let's just say, a pre-market low, and just off of the sole fact that the market broke their level with no other reasoning, not understanding context, not understanding the tape, not understanding market-related equities, correlated markets, they solely get in when their level breaks. Let's just say in this case, they short Tesla below the low. They don't have a plan, but they're getting in because they think the market's going to go down because they broke a pre-market low, and then immediately they get reversed on it and the market starts moving up. They stop out and they get extremely, extremely frustrated. This is the first step to the two-step process. Creating a level of interest is extremely important. I'm going to show you what I look for in mine, but just basic support and resistance, in my opinion, is not valid enough. We have to use more context, supply and demand, or just key levels, something that we spotted off of the tape. Once we get the market at these levels of interest, then we must react to what other participants are doing at those levels. We can't move the market. If I short, let's just say, Tesla below support, my order is not going to tank the market. So you want to position yourself to be trading with other people. You want to make sure if you are a seller, you want to make sure other people are selling after you. And if you're a buyer expecting the market to come up, you want to make sure other people are buying before and after you. That's very key. You want to make sure there is interest at your levels of interest. And how do we do this? We do this by reacting to what the market gives us, tape reading, understanding related markets, looking at volume, looking at the chart. Maybe some people use candlestick patterns. You just want to position yourself at your level of interest with the participant that you are looking to trade at. Without either of the two, I do not have a valid trading setup. It's vital. I will not take a trade if I can't read the market and understand these 2 points. The market moving up and down is not acceptable to enter. what you think is going to happen is not acceptable to enter. And entering a trade, guessing where the market's going to head next, is also not acceptable. I'm sure a lot of people are guilty of this. Totally cool if you are. But how many in the comments? Just let me know. Be completely transparent, be completely honest. I was myself when I first started trading. So to put this into some perspective, let's go over the pre-market plan. I post these every single day in my Discord, setups I'm watching, levels of interest, and potential trading scenarios. I think this is vital, not only for myself, for the trades that I am looking to take, but for other people to understand the levels that I was watching and why. So on the S&P 500 in the Discord server, back on December 6th, now this was a trade a few days ago. I think if you guys want this, I can make a video about all my recent trades and how I've been trading. And I've been absolutely killing the market with the setups I've been taking. And I kind of want to show everybody the setups that I am taking and how we could use this to prepare for the future. So if you want that video, let me know. I could, do that. I could create it and post it in the Discord if you guys want. But on the S&P on December 6th, the level of interest was 4018. If we can successfully reclaim above this, I'm interested in playing the market long, targeting the supply zone above. So look at the chart in the background. 4018 is the yellow line, and 4039 is the supply zone above. Now, if we fail to get above 4018 and broke below 3992, I am interested in shorts for a sell-off into demand below at 3972, 3960. This is the scenario that worked out. So briefly, where 4018 came from was the previous 4-week balance range high. It also acted as resistance, is this yellow line on my chart. It was basically the balance range high that once we got above it, we failed to stay above it. And if we reclaimed back inside of that balance range, then the balance range rules apply. That's why I wanted to see a breakout above 4018 that one day to speculate that the market was going to keep going up. And if we failed below it, then most likely we're going to keep selling off into the lower balance range, which was the demand zones that I mentioned as our targets. So that's our first step. That's where our level comes from. These are our levels of interest. It is a key level and a supply and demand zone. Now, the next step to taking a trade is reacting to what the market does. What happens if we come into 3992, let's just say, and immediately bounce? And yeah, the plan called for the short side, but what if we spotted buyers on the tape? Or Amazon and Tesla and, was rallying and VIX was selling off? That would indicate that we're possibly going to bounce from 3992 instead of break below it, even if the level called for a break below it. So this is why it's vital to react. Just because we hit a level does not mean you have to trade that setup. We must react to it and spot buyers and sellers. If we cannot spot these buyers and sellers via price action, then guess what? We just don't take the trade. And that's how simple it is. And a lot of people, what they'll do is they'll force the trade if they can't read it because they expect something to happen or they visualize the result and they're preparing for a future outcome that they cannot predict. And their brain is letting them believe what they want to believe. So essentially on this day, we broke below 3992. According to the pre-market plan, the levels, we failed below 4018. We got below 3992. And this is when I entered my short position. We broke down out of this level. Aggressive prints came through on the time and sales. I actually have a live recording of it. Maybe I could put it in the other video. We broke through this level. Very aggressive selling. The NASDAQ broke below support. VIX was rallying. And there were just other factors that gave me the reaction that's saying sellers are present. So we had the level of interest. We broke below it. We confirmed the trade. And now we have a valid trading setup to take the market short, targeting our demand zones lower. And this was an excellent setup by combining this two-step process. Now, why the two-step process is important is because let's just say we had demand in this area right here at 3972. This was a valid demand zone. And if you don't understand context, you don't understand just overall market conditions, yeah, we have a demand zone here, but the context of this was take profit at this demand zone rather than getting the market long. So if somebody creates a plan, let's just say, okay, we have demand at 3972. As soon as we hit 3972, I'm going to get long, right? That's just coming up with a level and not following the second process, which is reacting. So if we come up with step one, which is creating a level, right? As soon as we hit 3972, we're going to get long off of that sole reason that we hit demand, and then you would have got destroyed because you didn't react. if you reacted, you would have noticed there was no buying at this demand zone. So it would have prevented you from taking a setup. So it's simple as just playing levels, creating them, and leaving your emotions out of it and managing your risk. So by doing this, it's going to help us understand market context. Are we bullish or bearish below a level? For example, the plan yesterday on the S&P 500 was our 3919 and 3907 level. Again, this was in the Discord. The market sold off pre-market into this 3919 demand zone and immediately found buyers. Nice selling volume into this level. Buyers push out of it. And at this point, since we are bouncing off of 3919, that was a very important level from the past couple videos that I've been posting. We bounced off of it in the past, and we've been bouncing off it 3 other times since. With this context, I cannot be short bias above this level. In fact, I'm first looking to play longs targeting 3955 and 3965. So what happens here is the market hits this demand zone. We get a strong rally into 3955. At this point, this is where we took targets off for our long position, right inside of our 3955 level. Now, where this came from was the consolidation from the day prior, heavy volume at this area, strong sellers on the tape that bled into the next day, where we took the market long off of demand and took profit at 3955. With this level of interest, this gives us the context that we are bullish above 3919 and we are bearish below 3955, 3965. We can't be so bullish if we remain below that. So not only does it give us the context, but also gives us a solid reason not to enter. Let's just say in this case, right? What a lot of people are going to see here is a breakout of the high a day. Let's just say we don't know this level of interest. This chart looks bullish. Why does it look bullish? Putting in higher highs, putting in higher lows. So a lot of people are going to do is they're going to say, okay, we have high a day right here. And as soon as we break the high a day, I'm going to take the market long. However, if you knew the levels of interest and the plan, again, these are not made up levels. Every single level that I post has a strong significance in the market that I expect the market to react to. And it's my job to go with the flows of the market to take a quality setup. So this 3955, 3965 was tough resistance. In fact, the following day, still very tough resistance, and I was expecting upside above. So with this knowledge and with this context, with the current development in the market, playing long right here inside of this area of tough resistance just would not make sense. So understanding this gives us a solid reason not to enter, and it also will give us a solid reason to enter once we react. And it also gives us a valid trading. You need to have these things. If you're missing out on them, you're not going to have consistency and you're not going to be able to repeat your process on a daily basis. And then today on December 8th, Thursday, the plan remained the same. We had level at 3955 and we had the demand at 3919. The plan really did not change at all. I said we are stuck inside of this range, and for upside prices, we must get through 3955 and 70. Any strong buying here confirmed on the tape. Strong market leading equities. I am interested in playing long, targeting 3992, and then we also had a bearish scenario. So the market opened up, found acceptance here at 3955, and this is the level that I posted in my Instagram for everybody to see. But as soon as we spotted buyers on the tape, you can kind of see this better on a 1-minute chart. I took the market long right here, whereas I just explained to you yesterday, longing inside of the zone would not have made any sense. But today, the conditions and the reaction towards buyers on the tape was different today versus yesterday. This is why it's important to go with the flows of the market. We had VIX selling off from supply, and I took a stab at the market long over here at this oval, targeting 3992. We never got to 3992. I scaled out some of my position here at the highs at 3970, which is the upper balance range, and then I sold the rest as the market started moving lower. I took a stab at it again later in the day once 3955 held, and this became a very important level of interest that we were watching. In fact, when I was in this trade, I said the market cannot go up forever. There's going to be pullbacks. There's going to be consolidations. We're not going to go straight up to target. I said as long as we can remain above 3957 and 3947, that is good. I don't want to see it get back below. This was about 40 minutes into the market open when we looked like this. This is why it's important to have levels. It keeps us on the right side of the market and avoids us from being on the wrong side. As long as we remained above 5.7, which I'm going to remove this now, about 5.7 to 4.7, we were good. Guess what we did 2 different times? Bounced right perfectly at 5.7. So if anybody was very, very bearish, the downside moves would have been short-lived above 5.7. Now, this is where trading gets complex and unique, is you just get creative with it. Maybe some people found the short signal according to their strategy, let's just say right here, right? And their level of interest was 5.7. So what they could have did was they could have got short here. But instead of speculating a larger sell-off, take profit at your level of interest, right? You can get creative with it. There's tons of other opportunities, but we held this 5.7 2 different times. We came to the high and we put a double top in, and then we rejected from that double top and basically consolidated, where guess where we found support all day long? 3957, 3947. The levels are not made up. Every single level has a very important significance in the market that should not be let go or ignored at all. Understand levels of interest and react to what the market provides you. A lot of people take stupid setups based on what they think is going to happen, or they create a fantasized level that really has no important weight or significance in the market, and it goes against them when they try to figure out what they did wrong. Number one, the level wasn't good. And number two, they didn't react what the market did at their level. So I'm going to end the video on that note. I hope it helped. If you enjoyed it, I know this was kind of like an impromptu video. I wasn't planning on making this, but there was just such good action recently that I had to make this. And there was a lot of people I saw taking really stupid setups. So if you got any value out of this, I would appreciate a thumbs up, comment if you have any questions, and definitely check out the links in the description below. I offer a very in-depth and educational course that teaches all of this and also includes free access to the Discord. But I'm ending it. Peace out.